Hello and welcome. My name is James Kelly. I'm the Head of Aviation Finance at KPMG. I'm delighted, along with Airline Economics, to be joined this afternoon by Kalash Pandey. Kalash is the Global Head of Transportation Finance at Goldman Sachs, and he's joining us here in New York in October 2025 to get his perspective for the purposes of our CEO Leasing series. Kalash, can I start by just asking you about the role Goldman Sachs is playing at the moment in supporting airlines, in supporting lessors and their investments?
Yeah, first of all, thank you for having me here. And in terms of Goldman Sachs, we have a very comprehensive coverage model for transportation sector, of which aviation is right at the forefront. The coverage is, I would say, split across all things strategic. That would be M&A, board advisory, asset sales, etc. A robust capital markets presence, both public and private. So it could be IG, it could be structured, high yield, leverage loans. As well as in the last few years, we have made an active effort to support the sector and clients by deploying our balance sheet as well. So the coverage model across advisory, capital markets, public, private, balance sheet, it requires a global effort from a lot of bankers that come together. And we dedicate all our time to the sector.
Okay. And maybe if I just start with a macro picture on the sector, your sense on the performance of the airlines, maybe to break down a little bit regionally, so the Americas, EMA, ASPAC, how you're seeing the airlines perform. Are there any type of models or airlines that you're particularly concerned about as you look at it here in October 2025?
Yeah, I mean, if we talk about airline performance, perhaps we could start with traffic. So traffic has been up for 2025 by 5, maybe 6% in that zip code. So beginning of the year, the prediction was that it will be in the high single digit, 8-9%. It's not that robust, but it's still beating the GDP growth rate quite significantly. So one would think that the sector is rosy, although it has its own headwinds. When it comes to airline performance, we see that there is significant increase in revenue year over year, which is getting close to 950 billion, getting close to $1 trillion. But when you look at profitability, it's barely there. The margins are razor thin. We would expect, based on predictions, that profitability is right around 35-36 billion. Now, it's not very different from what it used to be even pre-COVID. The sector and its profitability has always been challenged because it is capital intensive and operating costs are high. But at the same time, despite what has been a very persistent inflation and higher operating costs for airline, they have benefited from certain other fundamental factors such as low fuel cost or continued leisure travel demand, premium travel demand. So there have been offsetting factors because of which globally the sector has remained profitable. Now, if you look at individual regions, there are different kinds of trends. So Middle East has been one of the most profitable ones. That hasn't changed. 2025, Latin America has emerged as a very profitable region. There are some more mature markets, Europe and North America. There is profitability, but it's not the same as compared to Latin America or Middle East in 2025. There's Asia and Africa, where generally speaking, the traffic growth is outpacing rest of the world, but profitability isn't. The margins are hard in those regions. So if you think about going into 2026 and what the trends would be, like in our view, we can clearly see a slowdown in North America, basically, where airlines have cut their outlook starting Q2, middle of the year. The stocks have not really performed that well compared to the broader index for North American airlines. And I would say China would be another region where a vast majority of large state-owned airlines are probably booking losses for the year. So overall, the traffic and the airline profitability globally looks like it is in good shape despite the headwinds, but there are some individual regions that are falling behind.
If I take that comment of the airline environment being reasonably robust and just apply that into leasing companies, right, their suppliers, what's your sense on the current leasing landscape and how it's evolving?
Yeah, I mean, huge changes, right, led by consolidation. We can talk a little bit more about it, but like when we look at leasing in 2025, 2024, call it last 12, 18 months, like the biggest trend is the supply strain that the industry is facing in terms of aircraft availability. So that supply constraint has come to a huge advantage for lessors with aircraft values going up, lease rates going up, and accordingly profitability going up. So to us, like that is the most prominent trend as it stands right now for leasing. We also look at the order book backlog with the OEMs, and it's quite staggering right now. So leasing is going to continue taking more and more share of that order book delivery, either directly or through sale leasebacks. So the leasing landscape currently is probably right under 200 billion in annual revenue. The forecast is that it will almost double over the course of next decade or so, which is like huge CAGR at like 8-9% there or thereabouts. And this is largely driven by the fact that airlines are also trying to be reducing capex and moving into asset-light balance sheet models with more consolidation in the lessor space, as we have seen constantly in the last 4 years or so. We think that is producing healthier lessor balance sheets, giving lessors cost advantage as well with economies of scale. And that is not just true of large lessors, like even in private equity style GP/LP lessors, the big ones are emerging out as the ones who have success in raising capital, and the smaller platforms are struggling. So the consolidation trend is true both in balance sheet lessors as well as the private equity style lessors. If you look at some other trends, like I think engine would be another one for leasing. Like engines have become extremely important. The values, the lease rates are high. Wide body would be another trend. Like it kind of started with oversupply pre-pandemic. So many of wide body assets getting parked right after pandemic to like coming to a point where there is shortage of wide bodies. So that is another trend. I think cargo growth would be another trend. So a lot of positives in the leasing sector. I should mention one more, that the financing market, like that is also so robust for lessors, like spreads are at all times tight, that it looks very good and very constructive backdrop for lessors.
Okay. Ask you one other macro question from a Goldman Sachs perspective. The investors coming into aviation, how is that evolving, and how is aviation competing with other asset classes, right?
Yeah, I think you have to see in the last 5 years the sector has come out from one of the worst stresses it has ever seen, and it did result in losses for investors who were looking for liquidity in 2020 or 2021. But for more patient pockets of capital, even if you made an investment in aircraft assets going into 2018, 2019, which one would have thought would be one of the worst times to make that investment, if you have held through your investment in turbulent times in 2020, 21, 22, you're probably going to make a positive return on your investment. And we are already seeing a lot of that activity in private markets where legacy ABS vehicles are getting refinanced. The trading activity between lessors as well as lessors to financial investors is quite high. CMVs are significantly above base values because of some systematic supply side issues in the industry. So what kind of capital is coming into the sector? I think it is all kinds. There's infrastructure capital with someone like Brookfield partnering with Castle Lake, Stone Peak acquiring ATSG. There's private equity with HPS coming in. There is Apollo that has been there but getting bigger. Insurance capital is coming in. Even on that's all on the equity side. Like even on the debt financing side, the loan-on-loan product, aviation CLO, as some people call it, has become popular. So CLO-style investors are also coming into aviation and seeing really strong performance. So I would have given a very different answer had it been 12 or 24 months ago, but the sector is really proving quite resilient for both debt and equity investors, and those trends are really hard to miss.
You mentioned earlier consolidation in the leasing sector, and I know Goldman Sachs have been involved in the aircraft GCAS transaction, the most recent SMBC ALC transaction. What's your sense on whether, particularly the most recent SMBC ALC transaction, is going to be a trigger for further consolidation over the next, let's say, 12 or 24 months? Or do you think it might be a slow burn as lessors consolidate slowly?
We do think the trend will continue for sure, because in order to get a competitive edge in the sector, you need scale, and that scale is for now only coming through consolidation, because the order book deliveries are still slow and unlikely to change in the very near future, given how big the order book backlog is. So that consolidation, in our view, is likely to continue. There's some public announcements already to that regard, but we think it will probably continue into 2026, 27. And that's not just true of the likes of GCAS or Air Lease, even some of the smaller players that are not making it to investment grade or that are struggling to raise private equity style capital. So coming out of COVID, we have seen a few of those, and I think that trend will continue with the likes of Fly Leasing or AMCK, a few others that have gotten consolidated into larger lessor balance sheets and private equity pockets.
Okay. To just switch gear, OEMs and your perspective on the OEMs, and particularly, are they starting to turn a corner, both on the aircraft and engine side? And what does that mean for how you structure deals and your risk appetite?
I think, from OEM order book delay and supply standpoint, it's actually in many ways improving the aircraft values. But in my view, it has also almost systematically changed the fundamental thesis in the sector that one would have expected going into late 2020s, where you would have expected that Neos and Maxes and Dreamliners, A350s will dominate skies, and that's not going to happen. So older aircraft demand, both from investor standpoint as well as the trading market between lessors, is more robust. We think structuring of deals is such that higher leverage against base values is easily supported. There is reduced amortization because depreciation curves are so much flatter. And if you look at what OEMs are producing, right, like it's roughly, last year was about 1,200, 1,300 aircraft that were delivered. You compare it to pre-COVID, you were close to 2,000. One would have thought that this year would get back to that scale, but it's probably not going to happen. So with about 16, 17, 18,000 aircraft backlog and annual delivery, which is struggling to get to 2,000, there is so much, like clearing this order book backlog is going to take a decade. And that's not what one would have thought 4 or 5 years ago. So that is why I say that the landscape has changed. It will take some time for new technology assets to become that prominent in terms of dominating the skies and having a critical mass. And then also the engine issues that started coming in last year will ensure that older aircraft and current technology assets just have to go for longer.
Okay. We focus maybe on rates, right? So in 2022, we had rates coming up. They've started to come back down here. The Fed has brought the rates back down. Can you get Goldman Sachs' prediction on where rates are going, given the geopolitical tensions in the air?
Yeah, I mean, after September FOMC meeting, when there was a rate cut, there's probably also more visibility that has been provided, and that there will be a package of rate cuts. So at Goldman Sachs, our view is there'll be 2 more rate cuts this side of the year, one each in October and then in December, 25 basis points each. and then 2 more rate cuts into next year, which would bring the terminal rates at around 3 to 3.25%. Now, that rate cut has an impact on the monthly rates. For the long-term rates, 5-year and 10-year, our prediction is 3.75 and 4.25% respectively across the next 2-3 years, which is exactly where 5-year and 10-year rates are right now. So the prediction is that it's going to be stable, but then you also asked like what impact will geopolitical tensions or continued inflation will have, and that can move it around. Like in the pre-COVID environment, spreads were a little bit wider than where they are right now, but the underlying rates were tighter. So a lot of the unsecured bond issuance or high quality ABS issuance will be at around 4%. Right now, risk-free rate is right around there, plus there is a spread on top. So all-in cost of financing still continues to be wider than the pre-pandemic levels. And this rate cut trend, which I mentioned in the US, is actually more or less true globally, perhaps other than Japan, but otherwise vast majority of large economies, UK and elsewhere, are also in rate cut mode. So we're going to see that consistency globally.
Okay. And you touched on earlier investment grade lessors and the importance of it, but that some people don't get there, right? Can I get your sense on why that is? Why are some lessors not able to get to investment grade? And then a separate question, what do the guys who are there need to do to maintain it?
Yeah, I think why some don't get it, it could be different reasons for different operators or lessors. The biggest one would be scale. It is hard to find scale in our sector. Despite the continued consolidation, scale is still a challenge. A lot of the rating agencies would say, they may not publish it, but they would say that for transportation leasing space, you need high single-digit $1 billion of deployed capital asset base, and that is hard to find, particularly if you're financing yourself in a high-yield market that tends to be wider than IG, to say the obvious. So that is one of the biggest reasons why one might not be able to get to investment grade. Having said that, there could be successful business models even without investment grade rating. Like if you look at the airline side of the business, because of Section 1110, because of Cape Town, the asset financing model is actually quite robust. WETCs or IG unsecured, Euro bond market, there's export credit and other credit enhanced products. So aviation does benefit from a lot of different financing products, even for sub-IG operating companies or lessors. When it comes to leasing companies, though, to be most competitive, margins are extremely important, and whatever you can save being part of the IG bond market, which is by far the most liquid market which is out there for debt financing versus term loans or ABS or high yield bond, that will definitely give you an advantage. And for that reasons, a lot of high yield lessors have either gone away or found their own niche or over time gotten themselves to IG rating.
And just to close out an IG rating, do you think either on the airline side or the lessor side we're going to see upgrades from here to the end of 2025?
There isn't anything, I don't think there's an upgrade or downgrade trend that will be too prominent. It's probably going to be situation dependent. If a consolidation is resulting in a more stronger balance sheet, that is an obvious candidate for a notch up in rating. Or if there is an M&A that results in the IG rating going away, then that will have impact in terms of more issuance in the market. But I wouldn't say there is one trend that would be more prominent, be it upgrade or downgrade from rating standpoint.
To move to the bank market, right, in the traditional aviation bank market, I suppose to come back 4 or 5 years ago, we saw some exits, and particularly in Europe, maybe some of the banks exiting that sector. What's your sense on the health of that market and the depth of it? And then particularly, are there any new or innovative financing products coming out of the banking market that you're seeing a lot of demand for out there?
I think bank market is strong. The volume in bank market is not as high, and that is a result of the fact that all different financing products are so constructive. We find ourselves in that perfect spot when IG, bond market, high yield, term loan, I said export credit and credit enhanced earlier, JOLCO, bank market, they are all very constructive right now. So lessors and airlines have a lot of choice. What comes into the bank market is absorbed at attractive spreads, but there isn't a disproportionate volume that is going into that market. Like we saw in 2022 and 23 when capital market spreads were not constructive and issuers did not want to lock themselves at higher coupons. So we think bank market is strong. Now there's impact of new Basel rules that will play out over the course of next few years. It hasn't had a significant impact at this point worth talking about. We do see that because of ESG considerations, mid and late life assets are finding more attractive demand from alternative and private credit investors as compared to bank balance sheets. But that's not to say that banks are withdrawing from that asset class in any way, shape, or form. It's just that number of active players for older technology or current technology assets in bank space is significantly fewer than new technology assets.
And then if I just flip to alternative lending, which has had some success but can be relatively specialist, do you see that becoming more mainstream, and what role do you see it having in the aviation sector?
I think it will have a continued role in aviation sector. Scale is again going to be a bit of a challenge because it's not that banks are in any way, shape, or form looking to shrink their footprint in the space. And if capital market is constructive, that is the deepest pocket that lessors and airlines would want to tap into in size over time. So I think there is room for private credit, and that has become quite prominent post-COVID. Some private credit players have also found a niche for themselves, be it some concentrations or some finding ways to give credit to EOLs, which are not that well understood by broader capital market. So we think the top handful players in private credit space are there to stay and will grow. The funding market for private credit investors has gotten better. So there's this Aviation CLO product which we had developed post-COVID that is becoming more and more mainstream. So it started with AA rating and now it gets to AAA, which is helping reduce the spreads in that market. So I think that will improve the margins for private credit investors and does result in some growth.
One of the trends that some of the CEOs you talked to speak about is lease rate factors and how they've gone up in the last number of years. Are you seeing noises on maybe airlines looking to buy their own aircraft, not lease aircraft, maybe tap things like export credit or supported finance to buy those aircraft directly, or will they still see leasing as being an important part of the overall capital stack?
I think leasing is and will remain an important part of the overall capital stack. There's no substitute for 100 LTV financing or funding that lessors provide, while also offering, if sale leasebacks are too competitive, there's gain on sale, which is important to airlines that engage in sale leaseback. And you're also just moving the residual value risk off your balance sheet as an airline when you engage in operating lease with lessor. So we think that product is there, has been there, and will be there to stay. Is there more competition from other products right now? There definitely is. But that is also not having as much impact on operating leasing market share overall because there is so much demand for aircraft. And even there have been sale leasebacks for mid and late life assets, which are not that common, but we have seen large airlines come with older aircraft package just to gain some more liquidity and reduce their exposure to engine issues and residual values by tapping into the right leasing pocket.
Okay. As we sit here in October 2025, and definitely the noise around New York is that the ABS market is back, it's resurgent, it's robust. What's your medium-term outlook for the ABS market and the role it plays in aviation finance?
Yeah, extremely important, right? We see IG bond market. I think it's 12 billion plus volume this year for lessors and maybe one or two airlines. You look at ABS volume last couple of years, it was hardly there, but this year it's probably going to get to 10 billion again. And as we look at trading in the secondary market for between lessors and financial investors, there isn't a right and perfect way to track it, but we think there's going to be 700 to 1,000 aircraft that are trading. These are mostly used aircraft, and by far the most constructive funding market for those assets is the ABS market. So spreads in ABS market being as constructive as they are right now, the most recent Castlelake ABS just last week priced at a spread of 155 basis point for A's. That is as good as it has gotten in the last, call it 12, 18 months. So with spreads being that constructive, the health of that market is really good. The lessors that tap into that market are getting attractive all-in rates. It will make them that much more stronger to get more collateral and originate more collateral in the trade sale market. And when we look at pipeline for ABS market, it continues to be strong. I think you will see some more ABSs this side of the year, and then the pipeline for 2026 looks strong as well.
And you think sponsor may try bolt an E-note transaction onto one of those transactions in the next number of months?
So we have already run a couple of E-note transactions, but those have been secondary E-note trades. So legacy ABS vehicles pre-COVID, we have sold E-notes from one financial sponsor to the other, as well as we have sold it to leasing companies. So that is already there. We are also seeing quite significant demand from financial investors, insurance, asset managers for that E-note product, even in primary form. It's just that the IG lessors that are users of ABS plus E-note program do not want to be the first one to run that exercise, largely because while there is strong demand from E-note type investors, it is still not resulting in a winning bid, which mostly is going to private equity style lessors who can price in the aviation inflation with more conviction than a financial investor can. So if I was to predict, I would say that E-note demand is already there. It's just that a primary issuance has not come in, so it should in 2026.
And do you think some of the ABSs that have been issued maybe over the last couple of years could get recut with a B or a C note as well as we look into the rest of this year?
Yeah, a lot of issuers have created that flexibility. They have put Class Bs and Cs. Even if they have not issued, they have put that in the priority of payments in the waterfall. So they have the flexibility to issue them. Even like some of the 2022 ABSs, there weren't that many, but whatever little was issued back then is coming out of the prepayment penalty window. So even more refinancings of post-COVID vehicle, which we haven't seen yet, but I think that will become a trend going into 2026.
If we go back to the macro picture for a moment, the airline environment and airline bankruptcies, right? And how is that impacting your lending strategies, your risk across all the products we've discussed? You know, ABS, traditional banking markets, the bond market. What's your sense on if they're moving the needle in any way?
Yeah, a lot of things we have discussed so far here, right? Like traffic, there's outsized growth versus GDP. The airline profitability, globally, it is there. Lessors are doing great. There's shortage of aircraft. The financing market is great. So like all things considered, it is great time to be in aviation. Now, of course, there are some bankruptcies on airline, depending on what region you look at, and that is always been the case. It's a cyclical industry. On average, it's a single B rated industry. So there will be bankruptcies. It doesn't give us a pause in terms of our outlook for the sector. But this is a sector where you have to monitor things closely. It could be airline credit at some point. Right now, there is also just putting more attention to the engine overhauls when you are coming in as an investor. Even if you are a debt investor in a concentrated pool of assets, the maintenance fly forward and the overhauls would be extremely important to analyze. So we have our eyes towards the appropriate underwriting features that are more prominent right now that I just mentioned. But I wouldn't say that it would give us any concern, and our balance sheet exposure is only increasing throughout 2025.
You mentioned ESG earlier, and it took a been frankly kind of a backseat in 2024 and 2025, but it sounds like impacting some lending decisions. Do you think it could come back into prominence in 2026 and 27, or where is it sitting?
I think it's hard to see that it will come with force in the very near term, not for the lack of trying, but there just isn't an alternative to current technology assets flying for longer, and then the sector needs to find ways to finance them. Even though airlines want to move from those assets into younger assets, there isn't a younger asset to find, and the deliveries are still struggling, as we discussed earlier. Combined with the fact that fuel prices are also low, which is not giving airlines as much of a pinch to operate the older assets. We think everyone will be mindful of moving towards the newer assets, but whether it happens in 2026, 2027, we just don't see that. But over time, as this 17,000 aircraft backlog starts delivering in force, at that point, probably in the next, I would say, medium term as opposed to near term, we'll see that trend get prominent.
Okay. As we kind of wrap our discussion, be interested in your overall optimism levels as we, again, sit here in October 25, and maybe the risks you're most concerned about.
Yeah, I think optimism is across more M&A and consolidation. I think we are going to see that trend. The pre-COVID financing volume annually was right around 100 billion, maybe slightly over. I think 2025 is getting there, so there's probably going to be more financing, capital markets and private and bank lending going into 2026. So that's again something we really look forward to. We think the early stake-private transaction showed a lot of creativity in bringing insurance capital into the sector. So that's again like being more creative, finding ways to attract new capital into the sector. That is something we look forward to. There were headwinds in 2025. We discussed that in the beginning of our session. Geopolitical risk, very, very stubborn inflation, high operating costs. 2025 found a way to offset those with attractive financing, with low fuel cost, so on and so forth. If fuel goes up significantly, or if credit spreads rise significantly, and the headwind factors are there to stay, or some more increased geopolitical risk, that could expose the sector to more significant risk. But going into 2026, we are full of optimism for more activity in the sector.
Okay. Kalash, with that, it just leaves me to thank you for your insights. I think our viewers will find them really fascinating. And continued success to you and Goldman Sachs.
Yeah, thank you so much.
Right, thank you.